A worse crash than 1929. Warren Buffett's terrifying warning. Warren Buffett is sounding the ominous alert of a crash worse than 1929. As global markets teeter on uncertainty, the Oracle of Omaha delivers a spine-chilling prediction. With echoes of history, his warning carries weight, fueled by decades of astute foresight. Is our financial foundation truly sturdy? Or are we walking on a precipice? Buffett's words reverberate, leaving investors and analysts alike grappling with the specter of a calamity surpassing the Great Depression. It was 1929, the period of the Great Depression. Although the economy did recover, people's minds were still terribly damaged. People's memories of 1929 became a symbol as a result of the stories they had told their children. If you said 1929, it would be equivalent to stating 1776 or 1492. Warren Buffett, the legendary investor, popularly known as the Oracle of Omaha, was born during the Great Depression. Warren's father, Howard, was 26 years old and working as a security salesman for a tiny local bank. He sold stocks and bonds, but he mostly sold stocks, and when stocks fell 48%, they were selling them to people. Prior to that, you wouldn't have felt like going out and dealing with those same folks a few months ago. However, when the stock prices dropped, everyone understood exactly what you meant. There wasn't much in their home back then, and Warren's father probably liked to shelter in place, which is another way of saying stay at home. They merely had a tiny yard. Because it was winter, his father wouldn't have been working in the yard while everyone else wasn't, you know? Warren Buffett's parents had a strong bond, and as fate would have it, Warren was born about 9 months after their harmonious connection. Unbeknownst to Warren, during his birth, the stock market was closed. However, upon his realization, it had rebounded impressively by more than 20%. In the autumn of 1930, the prevailing sentiment among people was disbelief about being in the midst of the Great Depression. Lacking the presence of television, their close-knit relationships obscured the severity of the situation. They perceived it as a recession, similar to ones they had encountered many times before, albeit not always intertwined with significant stock market events. The United States has experienced numerous economic downturns over time. In the initial 10 days following Warren's birth, the stock market even managed to increase by a marginal 1 or 2%. Yet this fleeting upward trend soon gave way to a larger decline, with the stock market plummeting from a level of 240 to 41. Before we dive deeper, make sure to hit that like button and subscribe to this channel for more incredible life-changing content. Now, let's move on. The era marked a significant downturn, notably remembered by Warren Buffett. He mentioned that he had been gifted $1,000 on the day of his birth and invested it in stocks, particularly the Dow average. That sum would have dwindled to a mere $170 in under 2 years. Such a drastic decline was an experience unfamiliar to most, as it wasn't typical to witness such a broad spectrum of American stocks plummet by 83% within 2 years, ultimately reaching an 89% decline from its peak on September 3, 1929. During this tumultuous period, less than a year after Buffett's birth, his father confronted economic challenges. His dad, an employee at a bank, was met with the unfortunate reality of the bank's closure, leaving him without a job. With 2 children to support, his father still had a grocery store to rely on. But it was during this time that both Charlie and Warren Buffett found employment under their grandfather's guidance. In 1940, Charlie joined the workforce there, and Warren followed suit in 1941. Reflecting on the era of the Great Depression, economists often downplayed its significance. However, had they possessed the safety net of the Federal Deposit Insurance Corporation, FDIC, which was established on January 1, 1934, even during the earlier years like 1929, the economic landscape could have been considerably altered. The FDIC formed a crucial component of the comprehensive legislative changes that unfolded with the rise of President Roosevelt to power. Warren Buffett holds the belief that the Great Depression was a result of multiple factors, even though some individuals place blame on specific events like the Smoot-Hawley Tariff Act. Various elements, including the margin requirements in 1929, played a role in precipitating the economic downturn. However, one significant aspect to consider is that during the Depression, more than 4,000 banks failed. Each of these failures represented a localized experience where individuals lost their hard-earned savings, further compounding the economic challenges of that time. Imagine a scenario where individuals diligently save and tucked away their hard-earned money, only to one day discover that their savings had vanished. This heartbreaking experience was not isolated. It occurred across all 48 states, affecting neighbors and relatives alike. Such widespread loss undoubtedly left a profound impact on the collective psyche. The FDIC emerged as a silver lining from this grim period, as Warren Buffett suggests. Without the bank failures that swept through the country, the trajectory of events might have been notably different. The bank closures left savers in shock, faced with signs that simply read, "Closed." The Great Depression's enduring impact on people's minds outlasted its actual effects. It wasn't until World War II that a shift towards Keynesian economics took place, marked by substantial fiscal deficits and a significant increase in national debt. The aftermath of the Great Depression witnessed an unprecedented percentage of GDP, a milestone never before reached and never matched since. While there was a substantial economic recovery, the scars left on people's minds were deep. The tales parents recounted to their children about the events of 1929 became emblematic, engraving that year's significance in the collective consciousness. Mentioning 1929 evoked a response similar to references like 1776 or 1492, events everyone knew and understood, profoundly affecting stock prices in a notable manner. Remarkably, it wasn't until January 4th, 1951, that the child born on August 30th, 1930, completed his college education before witnessing the stock market's return to its previous levels. Consider the span from 1929 to 1951, against the backdrop of a country merely 140 years old. This 20-year period out of the nation's 231-year history represented a prolonged phase devoid of economic growth and devoid of optimism among the people. The American economy, along with its thriving corporations, had gained substantial value over time. Yet it took 2 decades for the stock market to regain its pre-1929 birth of Buffett levels. This restoration of market prices to their earlier levels coincided with Warren Buffett's birth. This historical perspective prompts us to consider that as we currently face challenges that may span several months or more, we're reminded of the resilience exhibited by people during the 1930s. In that tumultuous era, individuals endured, persevered, and eventually thrived, contributing to the continuation of the American miracle. Interestingly, the year 1954 marked a turning point. The Dow Jones Industrial Average, which had started the year around 280, surged to a little over 400 by the year's end. Crossing the iconic figure of 381 from 1929 was particularly significant, and reaching the 400 mark symbolized a milestone in the market's recovery and growth. If you find this video informative, like and subscribe to this channel for more educational content. Let's continue. In 1954, there was a pervasive concern that history might be repeating itself, and people wondered if another 1929-like scenario was unfolding. While it might seem a bit implausible, the worry was real. The nation had changed significantly since 1929, yet the question lingered. This anxiety was so pronounced that it prompted Senator Fulbright, who later gained prominence for his role in the Foreign Relations Committee, to lead a special investigation through the Senate Banking Committee. In March of 1955, with the Dow at 405, Fulbright's committee brought together 20 of the most knowledgeable minds in the country to testify. The purpose was to determine whether the country was once again on the brink of an economic collapse similar to the past. Despite the Dow reaching the 400 mark, the country was grappling with deep-seated doubts about whether they were on the verge of another financial crisis. The lingering fear and skepticism during that time are truly remarkable, highlighting the profound impact of historical events on people's perceptions and beliefs. America's historical context played a crucial role in shaping its economic landscape. Warren Buffett's expertise on this matter is particularly insightful due to his direct involvement. He was working in New York for one of the individuals who was called to testify during that pivotal period. Ben Graham, one of the 3 most intelligent people Buffett has encountered, was among those called to testify. Buffett's vivid memory of this experience underlines its significance. During the testimony, when the Dow was at 404, Ben Graham's written statement included a notable line, quote, "The stock market is high. Looks high. It is high, but it's not as high as it looks," end quote. This statement reflects the cautious sentiment prevailing at that time. Subsequently, America experienced a robust economic tailwind, and the Dow surged. From that point, when the Dow made its remarkable ascent, it reached approximately 24,000. The current market landscape has yielded a remarkable return of $100 for every initial investment dollar. It's quite astonishing to consider that back then, all one needed to do was invest in a diverse range of American companies, and the returns would have been substantial. There was no need to constantly monitor financial news in publications like the Wall Street Journal, nor check stock prices frequently. The process was simpler and didn't entail high fees or expenses to intermediaries. This notion emphasizes the accessibility and potential for wealth creation that the American market has historically offered to investors. The essence of investing during that period was to believe in the resilience of the American miracle. You just had to believe in the miracle. Despite the challenging testing period between 1929 and the early 1950s, reflected in the cautious approach when the market reached 380, the faith in America's potential was somewhat diminished. However, history has demonstrated time and time again that nothing can halt America's progress. Even during tumultuous times like the Civil War and the Great Depression, the country's spirit and innovation remained unwavering. While there may be instances where America faces tests, whether it's during times of conflict or economic hardship, the underlying truth remains. America's ability to persevere and succeed has never wavered. This belief in America's enduring strength and resilience, from its inception in 1789 through various trials, holds as true today as it did during the nation's earliest days. Except for a few shrewd investors like Warren Buffett, no one considers planning for a market crash when the market is growing. That is what sets a great investor apart from a regular one. Pay attention to protecting your money rather than following the frenzied market clamor about how wonderfully the market is performing at the moment. If you found this video helpful, don't forget to like and subscribe for more informative content.